Hey everybody, this is Alex Merced from alexmerced.com, and I want to talk about the topic that's on many investors' minds. Is the market in a bubble? And there's a lot of reasons to think so. One reason is that the market multiple is really high. If you take a look at the multiple that the S&P 500 is trading relative to its profits, you can check this out by going to multiple.com, multpl.com. You'll see that the market is trading at currently 25 times its profits, which in its historical average is 15 times, or a stock trading at 15 times its earnings. So it's trading at fairly high. And if you take a look at the price trend over the history of the S&P 500, this is actually one of the higher points. So generally that'd be a sign that, hey, you're hitting the peak of a bull market. Two, we're expecting 2 more interest rate hikes between now and the end of the year. And interest rates going up is never a good thing for stocks because it means it costs more to borrow money, which means people who buy stock on margin, meaning they borrow money to buy stock, aren't going to borrow as much money, or they're going to be more selective about when they do. And on top of it, right now, if you take a look at the aggregate debit balance in the market, it's at historical highs, and it's been hitting historical highs for like the last 4 or 5 months about the aggregate debit balance. And what the aggregate debit balance means is the amount of people that investors in the market have borrowed to buy stocks. Okay, it's at historical highs. That means there's a historical level of buying going on when the market is trading at super high multiples, and interest rates are going to go up, which typically should trigger a lot of people to deleverage, meaning reduce the amount of money they're borrowing. On top of that, a lot of people expect that the reason why the market's trading up so high for no apparent reason is because they expect tax reform from the Donald Trump administration. And with Aaron Comey basically testifying this week, it just shows that the administration is in constant scandal, and then dealing with so many scandals at the same time that it won't be able to get any of these policies in place. So the expectations of tax reform will evaporate, and any basic gains in the stock market from it should be evaporating as well. And on top of it, a lot of energy companies should be taking a hit because of the recent hostilities between Saudi Arabia and Qatar. What's going to happen, or what has happened, is that the likelihood of OPEC reducing production of oil has shrank because these countries aren't getting along, which means they're not going to listen to each other. And if they don't reduce production of oil prices will not go up as expected. Instead, they are starting to already drop early this week, which is bad for certain parts of the U.S. economy. A lot of where our gains have been as an economy over the last decade have been in energy. So that's a bad sign. So all of these are bad signs for stocks, and you're starting to see that people in the market are feeling this because you're seeing that Treasury yields are rising, Treasury prices are rising, yields are dropping, which means people are running to buy government bonds because they're looking for safety. And if they're looking for safety, it's because they're worried about the market overall. They're worried about the economy. So there's good reason for fear. But again, the problem is markets can go up irrationally, and so this bubble could go further for who knows how long. You can be right and be wrong, and there could be all sorts of other factors that may be causing the price to go up. Again, deficits haven't shrank at any point, but neither has the amount of other countries buying our treasuries. Okay, if I remember a few years ago, China and Japan started reducing the amount of treasuries they bought. So basically, who's there to pick up the difference? The Federal Reserve, who will be increasing their buying of bonds from banks and broker-dealers in order to facilitate a U.S. deficit that just keeps on growing and debt that keeps on growing. So a lot of the stock price increases just might be just from the increases in liquidity from all this facilitating by the Fed. And a lot of that may not even be transparent and necessarily on its balance sheet because it could be facilitated through interest rate swaps and other methods. Now, the thing is, the Fed has been raising interest rates, but again, raising interest rates, basically raising the discount rate and benchmark rates, have little to do with whether they've actually reduced the amount of money in the economy. I do think that the Federal Reserve is taking some of that money back through a reverse repurchase program, but again, they can still play around with the liquidity in the economy and the amount of money in the economy in different ways to help facilitate making sure that basically the government can borrow the money it needs. So that's the only reason I can think that the market's still going up, that basically the Fed is facilitating it. Because otherwise, there's really no reason for the market to be going up the way it has. That money has to be coming from somewhere. So that's my opinion on the matter. I could be totally wrong. Maybe I'm right. Time will tell. Bottom line is, everything I said here is just my opinion and my thoughts on the matter. And you shouldn't make any investment decisions purely based on what I say. You should always talk to a licensed investment professional who can help inform you on what's the best thing to do depending on what your investment goals and investment experience are. But hopefully this just kind of give you an idea of why people are expecting a bubble and help you know what kind of things to keep looking out for in the news. So my name is Alex Merced from alexmerced.com. If you'd like to learn more about economics, go to learneconomicsnow.com. And if you want to be a libertarian like me, go to libertarian101.com. Good times.